Hello everyone. My name is Anjani Kumar Khetan. I am based out of Bangalore. And today we are starting a new series of videos dealing with the recent amendments to IAS 21 and Ind AS 21, dealing with what is known as lack of exchangeability. Now, before we go into the topic per se, let me first say sorry to all of you because I was not been able to record new videos over the last few weeks. First, I was traveling, and later, because of various other reasons, I was not able to record new videos. But my endeavor would be that go forward, every week at least one new video is something which I share with all of you. Thank you for all your support to the channel and to me. Now, with that, what we are going to cover, as I said, lack of exchangeability. Now, the key thing which we are going to cover in this particular video is to understand what is the meaning of this expression, lack of exchangeability. In what circumstances this is relevant? What is the genesis of this? How this amendment was something which was required, what triggered this particular amendment. And post-amendment, what is it that is changing from the perspective of the preparers of financial statements? Now, before we get into all of these, it is very, very important for all of us to understand what is the core requirement under IAS 21 and Ind AS 21 from the perspective of the foreign currency transactions and foreign currency balances. So what happens? Let us say, if you are an Indian entity, with INR as the functional currency, and you are preparing your financial statements in INR. However, assume that you have entered into a transaction wherein you have raised dollar-denominated foreign currency loan. Now the question is, assume on this date, when you have raised the dollar-denominated loan, let us say the exchange rate between the INR and dollar was 84. Assume $1 million is something which you raised the loan. Now the question, one of the questions which is addressed by Ind AS 21 and corresponding IFRS literature IAS 21 is, when the Indian entity is recording this loan transactions in its India books with INR being the functional currency, what is the rate? How much they should record this particular loan? Right? So this is one of those issues which are addressed by these standards. Now, assuming this loan was raised on 1st of, say, February 2025, which is expected to be repaid in a bullet repayment, let us say on 31st of March 2030. Now, if you have raised the loan on 1st of February 2025, let us say on 31st of March 2025, when your financial year comes to an end, obviously this foreign currency loan of $1 million is still outstanding. So you have a balance of foreign currency dollar loan of 1 million as of the reporting date. Now assume that if the exchange rate moves from 84 to 86 on the day of the year-end close, that is on 31st of March 25. So another question which is being addressed by these two standards, Ind AS 21 and IAS 21, is how would you deal with such change in the foreign exchange rates when you have foreign currency denominated balances, monetary items lying in your books of accounts. So let us see that in the next slide with this context. What is it that the two standard prescribes, that if you have a scenario like this, how would you deal with it? So for example, the same example which I said, on initially in my example on 1st of February, on 1st February 25, when you have a foreign currency loan which you have entered into or you have raised amounting to $1 million. So if you look at paragraph 20 to 22, these paragraphs of both the standards, it tells you that, let's say at paragraph 21, that at initial recognition, all foreign currency transactions, in my example, that loan of $1 million, shall be translated to functional currency INR by using the spot exchange rate between the functional currency INR and the foreign currency dollar, in my example, at the date of transaction. So in my example, if 1st February was the date, 1st February 25 was the date on which the loan was raised, that means on that particular date, whatever is the exchange rate between the two currencies is what, in my example, 84 rupees, is what you will use to translate and record the loan. So $1 million of loan into 84 million INR. That is the amount at which one should be recording the transactions in the books of accounts. However, the standard also permits to use some average rates as well rather than the rate on the particular date, provided those rates do not fluctuate widely. But generally, most of the entities would be using the average rates, let's say monthly averages or weekly averages they will be using, provided the exchange rates do not fluctuate significantly. But net what we are saying is, when you have a monetary item like the loan, debtors, creditors, when you have which are denominated in foreign currency, then at that point in time, on the day of transaction or possibly the average rate between the two currencies is what you would be using to record such foreign currency transactions into your functional currency. Now, for this purpose, date of transaction is the date on which the transaction first qualifies for the recognition purposes in accordance with Ind AS. Right? So in the example which I gave, if 1st of February 2025 is the day on which the transaction qualifies for recognition, that is the date on which you will look for the exchange rate between the two currencies. And this date of transaction is also basically considered as the date when the conditions for initial recognition as an asset or a liability are effectively met. Of course, in line with the requirements of the standards. Now, this is our initial recognition. The next question which I said, on 31st of March, you entered into the loan transaction on 1st February. Now, 31st of March, when your year-end period is there, now exchange rate moves from 84 to 86. How do you deal with it? So, on subsequent recognition, what do? Subsequently, at subsequent period, paragraph 23, it gives you the guidance that at each subsequent reporting period, in my example, 31st of March 2025, the balances, the $1 million of loan, that balance is translated as follows. We are only focusing at this point in time on monetary items. There are guidances for non-monetary items as well, but our primary focus for this particular video is on the monetary item. So monetary items like receivable, payables, loans, which will be settled in the fixed and the determinable amount of currency. Now that it needs to be translated using the closing rate on the date of the reporting period. So in my example, if the closing rate is 86 rupees as of 31st of March 2025, this 86 rupees is to be used to translate the foreign currency balance of $1 million as a loan in your books of accounts. And the difference between 84 and 86, the 2 rupee delta on 1 million, that means the 2 million difference will be taken as a loss to profit and loss account. So this is the core requirement which is there under Ind AS 21. Of course, as I said, there are other requirements with respect to non-monetary items as well. I have listed it here, but that is not something which is very, very relevant for our discussion. Now, of course, non-monetary items which are recorded at historical cost, they do not require to be translated. They continue at the historical rate. However, if non-monetary item is recorded at fair value, say for example, you have a property, plant and equipment which has been revalued under the revaluation model, then in that case, exchange rate on the day when the fair value was measured. That is the basis. Basically, if your last revaluation that day, if the exchange rate was 80 and today the rate is 84, then you will apply 84 to 80. That is the ratio to restate the numbers. Now, having said that, now given this requirement, what potential issues it has created and why that lack of exchangeability amendment was required. Now, this is the prelude and the background to what the standard requires, both pre and post amendment. But then, with that said, the problem happens that in case of situations when the two currencies are not exchangeable, then how to deal with it? In our example, USD and INR are the two currencies involved. Now, for if some reason this conversion or the exchangeability do not exist between these two currencies for, let's say, a relatively longer period of time, then how you deal with it? Let us first see the concept of lack of exchangeability, what the issue is, and how it all started. So what is the issue? So as I mentioned in the earlier slide, both these are standard, Ind AS 21 under IFRS and IAS 21 under IFRS and Ind AS 21 under Ind AS framework. They set out the exchange rate that an entity uses when that entity reports foreign currency transaction and balances. In my example, transaction at 84 rupees, balances at 86 rupees in the example which I gave. In the functional currency, or how it translates the result of a foreign operation in different currency. So for example, let us take another example. This transaction we have already considered, that a reporting currency in India, an entity in India, which has functional currency as INR, it has a dollar receivable or payable, then in that case, this is the guidance which you have to apply, which we saw in the last slide. But let us look at another example or another scenario. I am an entity, let's say I am a parent entity of a branch which is there, let us say in US. There's a foreign branch which I have in US. Now this branch has its financial statement denominated in dollar. Now, when I am consolidating my books, I have to consolidate the branch financials into my India books. I am the India parent entity. Now, the dollar denominated financial statement of the branch need to be incorporated by way of translation process into INR. That means you have to convert the balances or dollar balances of the US branch. You have to convert it into INR using the conversion rate. So these two standards, they give the requirement that when you have a requirement to translate the result of a foreign operation, say the branch of an Indian entity, which has the functional currency in a different currency. In my example, dollar is the functional currency of the US branch. But it needs to be translated, the results of that branch needs to be translated into INR so that the consolidated financial statements are prepared by the India parent entity. So in that case, which exchange rate to use? So before these amendments to these standards until recently, these two standards, they provided guidance that when the exchange rate, what exchange rate is to be used when the exchangeability between the two currency, in my example, INR and dollar, if the exchangeability between the two currency is temporarily not available. Paragraph 26 used to give the guidance. That means if the exchangeability between the two currency is temporarily lacking, paragraph 26 used to give the guidance. However, there was no detailed guidance that if that exchangeability is other than temporary, that means if it is more permanent, then what do you do? There was no explicit guidance for the determination of the exchange rate between the two currencies when this lack of exchangeability was not temporary. It was more prolonged. Then in that case, there was no guidance. And therefore, this led to wide diversity of practice, leading to material differences in how the preparers of financial differences used to report transactions when the exchangeability between the two currencies was not temporary. So that is the problem statement. So this was the issue. Now let us see on the continued on the next slide. Although we know that lack of exchangeability is not very usual, and even if it happens, it will happen mostly very infrequently. But of course, it is possible. In certain geographies, in certain economies, let's say for example Venezuela, right? It is certainly possible that in certain economies, these kind of situations may arise. So if it is there, if such kind of the lack of exchangeability do exist, it can exist because of various reasons. So for example, this lack of exchangeability may arise because the government of a particular country might impose controls on import of capital items. So for example, if a country is struggling with the foreign exchange, let's say position or balance of payment situation, they may say, okay, when it comes to import of capital goods, it is not allowed. That means import of only, let us say, essential commodity is required. If you want to buy medicines or import medicines, yes, that is allowed. But for certain essential imports, the other items, let us say, are not allowed because the government has imposed control, wherein, let's say, capital goods are not allowed to be imported. That can be one scenario where the exchangeability between the two currency will not exist for one of the purposes, that is import of capital goods. Likewise, the government may also provide sometimes the official exchange rate, but with certain limits of how much currency you can obtain at the official rate. So likewise, it may arise, this lack of exchangeability may arise when a government provides an official exchange rate. However, it limits the volume or the quantum of the foreign currency transactions that can be undertaken at that official rate. Now, this could again be the reason or the trigger because of the balance of payment situation, as an example, the country might have. And therefore, let us say if for a particular purpose, government says only $1 million is something which you can take the forex. Beyond that, you are not allowed to take the forex because of the constraints and the controls placed. Now, assuming if another entity needs 1.5 million foreign currency, then there is a difference. 0.5 million is not available through the official channels. Then what will happen? Therefore, market participants are not able to buy and sell the currency to meet the needs of the entity at the official exchange rate. Now, entity needs 1.5 million, but because of the controls placed, only 1 million is available. That means to the extent of the difference of 0.5 million, at the official exchange rate, the currency will not be available. This will also force then the entities to move to some unofficial or parallel market, if at all those markets do exist in that particular economy. So therefore, they may try to go for unofficial markets if those markets are available. Now, although a few jurisdictions today are affected by this kind of a situation, however, if any particular jurisdiction actually gets impacted by this situation, then the impact could be very, very significant for those who are actually affected by scenarios of lack of exchangeability. Because millions and millions of dollars might be involved when it comes to translating those balances. So therefore, this amendment provides guidance that will increase comparability, tells you what to do if the lack of exchangeability kind of a scenario is there. How should you go about the conversion process or translation of those balances? And because there is now a standard requirement in the amendment, which we will see, this will eventually increase the comparability between the financial statements and of course will provide more useful information to the users. Now, this is the context and the problem statement. Now, how it all started, what triggered that the standard setters think about this issue and propose the amendment. Let us see what was the genesis, what led to all of this, how it all started. So the genesis of the issue lies in a request or a submission which was received globally by IFRS Interpretations Committee about how to determine the exchange rate in a scenario when there is a long-term lack of exchangeability. Now, this particular request was with a specific context from Venezuela. So, this question was posed to the IFRS Interpretations Committee on a specific situation faced by a preparer of financial statement in the context of the operations it had in Venezuela. So for example, let us say you are a European parent. The parent is in Europe with euro as the functional currency. As an example, I'm saying. Now assume that this particular European company has a branch in Venezuela, where Bolivar is the Venezuelan currency. Now, because of the fact that there is a long-term lack of exchangeability between these two currencies, for whatever reason, let us say the government has put a control on the exchangeability between, say, euro and the Bolivar. Now, the question is, in that scenario, this was the question raised, that because of the fact that there is a long-term exchange, there is long-term, lack of exchangeability between Bolivar and euro, how should I deal with it when I am translating, let us say, my, Bolivar denominated financial statements for, let's say, consolidation purposes into the euro by the European parent. Now, in this case, because there was no specific guidance available under the existing standard to deal with the long-term lack of exchangeability, and therefore, this interpretation committee acknowledged this fact that this issue is currently not addressed by the existing set of standards. And therefore, this interpretation committee recommended the board, the International Accounting Standards Board, to develop a narrow scope amendment to address this kind of an issue. So this is the genesis of the entire issue. Now, what happened? Because of the fact that the IFRS Interpretations Committee referred the matter to the IASB, consequently, on 15th of August 2023, the IASB, after detailed public consultation, issued amendments to IAS 21, and then that amendment now tells what is the situation or how to deal with when you have a long-term lack of exchangeability. Now, of course, from an Indian context, in May 2025, the MCA also notified the similar amendments to Ind AS 21. As you know, we have converged from an Indian perspective, we have converged our Ind AS literature to the IFRS literature, and therefore, similar amendments have been brought into the Ind AS framework as well, wherein Ind AS 21 was similarly amended by MCA in the month of May 2025. Now, what that amendment? Now, obviously, as I said, this amendment represents basically a response by the standard setters to the problem which they have faced. In the example which I said, that the specific issue was raised by the preparers of financial statement in Europe and Venezuela, right? So that situation was there. So it represents a response specifically given by the standard setters to the comments from various users of financial statement which have raised concerns regarding the diversity of practice pre-amendment, because before the amendment there was diversity of practice, as I just mentioned. So now let us look at what is the new guidance. So what this amendment tells you, what to do if you have long-term lack of exchangeability, then what do you need to do? So the standard has introduced a two-step approach. What is this? It is very simple. What it says, the amendment tells you that in step 1, you got to look at whether the currency is exchangeable. In my example, the Bolivar and the euro. So, if you read paragraph 8, 8a and 8b together, both under the Ind AS 21 and IAS 21, step 1 for this, the evaluation is that whether the currency, these two currency, are they exchangeable into another currency at the measurement date for the specified purpose. Now see here, I have broken down the requirement into the various parts. So the example which I gave, that let us say if a country says that you can import for medical reasons, but you cannot import for capital goods. So here, when you are assessing whether the currency is exchangeable or not, you have to also look at the purpose for which the exchangeability is needed. So when let us say if you have a foreign currency balance for import of capital goods, then the exchange rate, because in a particular country, in the example which I gave, this import is not allowed. And therefore, the exchange rate which is available is for a different purpose, not for the capital goods import. So, what step 1 tells you, that you have to assess whether the currency is exchangeable into another currency at the measurement date, in my example, reporting date, let's say 31st of March of a particular year, for the specified purpose. And of course, if the answer is yes, no brainer, then you apply the guidance in Ind AS 21 and IAS 21, which we saw at the start of our discussion, that monetary items use the closing rate. So then you apply that guidance, no brainer. So apply the applicable guidance under Ind AS 21 and or IAS 21 as the case may be. So that is not a problem. But if the answer to the first step is no, the currency is not exchangeable, the example which I gave, that for the specified purpose in question, the currency is not exchangeable, then what happens? Then this is the guidance in the standard. It says, estimate the spot exchange rate when the currency is not exchangeable. Put differently, what the amendment tells you, that at the measurement date, having decided that the currency, these two currencies, are not exchangeable for the specified purposes, having decided that, then you, at the measurement date, at 31st of March in my example, estimate the spot exchange rate between the two currencies, which meets the objective of Ind AS 21, and this objective have also been given, newly inserted in paragraph 19A. And how would you do that? When you are saying that you will estimate, the estimation of the spot exchange rate can be by one of these two methods. The first being, use an observable exchange rate without any adjustment whatsoever. If you have such rate which is available from the market, use that observable exchange rate from the market. For this, we will refer paragraph A11 to A16. Now, if for some reason this is not there, then alternatively, spot exchange rate need to be estimated by using some other estimation technique. Again, relevant paragraph is paragraph A17. Now, this is the gist of a very simplistic way of telling what the amendment tells you. Of course, it requires much more deeper analysis and deep dive into what and how you go about this. How do you estimate it? So a deep dive of these steps is something which we need to discuss in subsequent videos. This is just a prelude of the requirements, or introducing you to the subject of your lack of exchangeability. Having understood this, having understood the key requirements under the amendments, now next video, we will deep dive into step 1, how you go about the specific nuances to be tackled for step 1. Then we will go to step 2. So next video will primarily be focusing on step 1 and followed by another video where we will be looking at step 2, how to go about it. Of course, I will include in the later part of the video series the case studies and examples as well, primarily leveraging from the illustrative examples given in the IFRS literature in terms of how one need to deal with the entire situation of long-term lack of exchangeability. So that's what I wanted to cover for this particular video, just to set the context. Of course, this is a list of videos, useful videos which you can use for your any of your professional reasons. And of course, this is the QR code for my YouTube channel. Please do subscribe, comment, share it with your colleagues or anyone who needs this kind of a video. So this is what I wanted to cover for this particular video. I'll take a pause and take your leave. I will see you in the next video next week. Thank you. Bye for now.